If your bank limited withdrawals to $100 a day starting tomorrow, how prepared would you actually be? That has already happened. Not in some distant century. In modern countries. Argentina, Lebanon, Greece. People woke up, opened their apps, and realized the numbers on their screen weren't fully accessible anymore. And here's the part no one tells you. When money weakens or trust breaks, wealth does not disappear. It transfers. Some people panic. Some people lose years of savings. And a small group quietly gets richer. The difference isn't luck. It's what they own before the instability starts. Most people prepare for stability. They assume the system will always function the way it does today. But history shows something uncomfortable. Monetary systems change. Sometimes slowly, sometimes suddenly. And when they do, 3 types of assets consistently protect purchasing power better than paper promises. If you understand these 3, you stop reacting emotionally to headlines and start positioning strategically. Let's start with what really happens before collapse. It doesn't begin with chaos. It begins with erosion. Prices rise gradually. Debt expands. Governments print more currency. Asset prices inflate. People notice things are more expensive, but assume it's temporary. Sound familiar? Here's where most people get caught off guard. During this slow erosion phase, cash quietly loses purchasing power. Your savings account balance might look stable, but what that money can buy shrinks year after year. And at the same time, real assets begin repricing upward. That's the transfer starting. Look at Argentina in the early 2000s. The peso collapsed. Bank withdrawals were restricted. But property values in local currency terms surged dramatically. After 2008 in the United States, people with liquidity bought foreclosed homes at massive discounts. In Lebanon in 2019, depositors were frozen out of their savings, while those holding tangible assets preserved far more leverage. Wealth didn't vanish, it relocated. Now, here's the uncomfortable question. If your entire net worth is sitting in cash, retirement accounts, or bank balances, what happens if trust weakens? That's not fear, that's risk assessment. So let's break down the 3 asset types that have consistently outlasted currency instability. Asset number 1, productive real assets. Not speculation, not hype. Production, land, rental property, businesses, infrastructure. Anything that generates value independent of the currency used to measure it. A farm grows food, whether inflation is 2% or 20%. A profitable business produces goods and services regardless of monetary policy. A rental property provides shelter no matter what's happening in financial markets. Real assets represent output, and when currency weakens, output gets repriced upward. But here's the nuance most people miss. Real assets protect wealth when structured properly. Over-leveraged speculation destroys it. People wiped out during crises are often those with adjustable rate debt, thin margins, or fragile financing. Meanwhile, disciplined owners with fixed rate structures and cash flow often survive, and sometimes expand. Now let's move to asset number 2, scarce stores of value. Gold and silver have survived every major monetary reset in recorded history, not because they grow earnings, because they are scarce. Governments can expand money supply instantly. They cannot create gold with a keystroke. When confidence in paper weakens, people move toward scarcity. Even central banks hold gold reserves. That alone should tell you something. Now, this doesn't mean you go all in on precious metals. They don't generate income. But historically, even modest allocations have acted as insurance during periods of instability. Insurance isn't exciting, but neither is losing purchasing power. Now here's the 3rd asset, and this one is the most powerful long-term. Skills. When systems get unstable, competence becomes currency. During economic crises, people who can solve problems continue earning. Builders, technicians, medical professionals, engineers, salespeople, entrepreneurs. People who create value don't disappear when money becomes unstable. If your wealth depends entirely on numbers in an account, you are exposed. If your wealth depends on your ability to generate value, you are adaptable. Skills cannot be inflated away. They cannot be frozen by a bank. They cannot be digitally erased. And in periods of disruption, adaptable people often rise faster than those who relied purely on paper wealth. Now let's zoom out to something critical. Most monetary breakdowns follow 3 phases. Phase 1 is erosion, slow inflation, expanding debt, rising asset prices. Confidence remains high. Phase 2 is acceleration. Inflation spikes, interest rates jump, bank failures occur, headlines intensify, trust starts cracking. Phase 3 is loss of confidence. This is when repositioning becomes difficult. Here's the mistake most people make. They wait for obvious panic before adjusting. But by the time panic is obvious, flexibility disappears. Prepared individuals move during Phase 1 and Phase 2, not because collapse is guaranteed tomorrow, but because incentives are clear. Modern economies depend on expanding credit. Expanding credit pressures purchasing power over time. That doesn't require apocalypse. It requires math. So what does intelligent positioning actually look like? It means not keeping your entire net worth in low-yield cash. It means owning assets that historically adjust with inflation, diversified equities, productive real estate, business ownership. It means viewing precious metals as insurance, not speculation. It means investing in your earning power, certifications, trade skills, digital capabilities, entrepreneurial leverage. It means reducing fragile structures, excessive high-interest debt, adjustable rate exposure, or overdependence on one institution. Wealthy individuals already think this way. They diversify across asset types. They build multiple income streams. They own productive capacity. Not because they expect chaos tomorrow, but because volatility is inevitable over long time horizons. Paper money depends on trust. Assets depend on utility. Skills depend on competence. Only one of those can evaporate overnight. And here's the shift most people never make. The average person prepares for stability. The wealthy prepare for volatility. Volatility feels uncomfortable, but it's also where the largest wealth transfers happen. After 2008, prepared buyers acquired assets at historic discounts. During inflationary spikes, those positioned in appreciating assets saw net worth expand while cash holders lost ground. Wealth doesn't disappear in instability, it transfers. So instead of asking, will money fail? Ask this instead. If trust weakens, what do I own that still produces value? Land produces. Scarcity preserves. Skills create. Those 3 categories have consistently outlasted paper promises across centuries of monetary shifts. You don't need fear, you need positioning, and positioning happens before panic. If this shifted how you see money and volatility, watch the next video on your screen where I break down exactly how much invested capital you need to generate $500 per month in income. Because owning productive assets isn't theory, it's math. And once you understand the numbers, you stop hoping for stability and start building it.